Hello guys, welcome to my new and improved video about Fluor. I have a few upgrades. I bought a new mic and I actually wrote a script for this video, so hopefully I could really do this the right way this time around. Before we start, I just want to put the normal disclaimers out there. I own stock in this company. I'm not a financial advisor and this is not financial advice. Please do your own research and invest at your own risks. Of course, I think this company is good, but who knows? There's a million different things that could happen, and anyone investing in this needs to know the risks for themselves and do their own research and be careful, because that is the name of the game in investing, is protecting your downside. Also, this video will not have any discussion about NewScale. NewScale, obviously, for those of you who know, is a very important piece to the Fluor puzzle. It's a very, very critical component of their turnaround. And I really want to make a separate video about NewScale and dedicate it all to NewScale to really do this topic justice. So, keep an eye out for that. That should be releasing in the coming weeks. So for those of you who didn't see my first video and have no idea what I'm talking about, let me tell you. I feel as though I've stumbled upon a very interesting gem of a company. It's trading at a deep, deep discount from its intrinsic valuation and where it has historically been. The company is a Fortune 500 engineering, procurement, and construction company founded in 1912. And that company, of course, is, as you can see, Fluor. Before we talk about the really, really exciting things here, I want to talk about the bad risks. I think that's one thing that will hopefully set my channel apart from other channels, is that I'll give you a holistic view of what's really going on. You'll be able to see the risks and all the potential rewards here, not just one or the other. As you can see, Fluor has just taken a hammering since 2014. It's down about 80% from where it used to be. Normally, the stock, even as late as 2018, was a $40 to $50 stock, but now it's all the way down at $16, $18, and the market cap is only $2 billion. So the business has really been struggling. And that's really due to two factors, which I'll outline now. The first factor is broadly defined as fixed price contract bidding. Essentially, Fluor started pivoting towards bidding on contracts where the maximum price for their customers would be fixed. This is obviously a big advantage because as a customer, I get to know before my contract has even started what it will cost me before it's even built. Fluor felt that if they invested more in their cost estimation and bidding processes, that the risk that they take by guaranteeing a maximum priced contract would be more than offset by these new processes that they implemented, and they'd, as a result, be able to undercut a lot of the competition and be able to win these projects and build these projects. Unfortunately, this plan failed pretty catastrophically, and as of September 3rd, 2021, Fluor was left with about $1.2 billion in lost contracts that they need to fund. There is a slight silver lining, though. Luckily, these contracts are being completed at a rate of about $700 million annually, and they'll be completely finished sometime in 2023. These contracts are now also at a stage where the costs of completing the contract will be offset by the revenue that they collect on the contracts. So, one of the major questions you have to ask yourself here is, do you think Fluor will continue to have cost overruns? Do you think that they'll be able to stop doing fixed price bidding altogether? To address this, management has decided to basically do just that, to just say, we're not going to bid on fixed price contracts, with the exception of the infrastructure segment. This is essentially mostly due to their poor track record on these contracts and all the cost overruns. They feel that it's just not worth it to them to be able to do these fixed price projects. The only reason they're making an exception for infrastructure is because the government uh, generally sets these bids up, these contracts up, so that they are always fixed price or almost always fixed price. I don't know if there's any exceptions, but that as a general rule, these infrastructure projects are fixed price projects. So that is really the crux of the issue. So the second issue that's going on here for Fluor is they're very reliant on the oil and gas industry. Setting aside the U.S. government, ExxonMobil was their largest customer at about 13% of their revenue. Um, Fluor derives a large portion of their revenue from oil and gas. Unfortunately, I'm not able to get exactly what the figure is, but I do know that energy and chemicals combined, those two segments combined, were approximately 45% of their total backlog. So, energy could be a lot of different things. Yeah, I think it even includes carbon capture in that broad definition. So it's lower than 45%, especially if you take chemicals out of there. That I would say is a pretty big business too. But you could assume 45% just to err on the side of caution and be ultra conservative. So, all this that has been occurring, plus COVID, of course, has led to the company losing $1.5 billion in 2019 and $300 million in 2020. So at this point, you should probably be asking yourself, what on earth am I doing investing in an oil and gas company losing literally billions of dollars? Well, first, I'd like to point out that the losses are not pure cash burn. Fluor's operating cash flow is positive. So the operating business itself is producing positive cash flow. Much of the earnings or the net losses are coming from charges that they've taken on projects or asset impairments, where essentially an asset was recorded on the balance sheet as having a dollar in value, and then they're saying this asset's only worth 50 cents now. So they're impairing the asset. That obviously there's no cash outlay to do that. It's just a reduction in what the value of the asset is stated as. So that's partially why operating cash flow is positive, even though you're seeing these huge net losses. It doesn't make complete intuitive sense, because you would, at least I know I would expect, if a company is losing money or if their earnings are negative, their operating cash flow would be negative as well. But that's actually not the case here. Even if we look at free cash flow, which is just deducting expenses of reinvesting in the business, repairing equipment, what's commonly known as capital expenditures, we still see that in 2019, Fluor had positive free cash flow of $40 million, and in 2020, $70 million, positive free cash flow of $70 million. So, just using operating cash flow, it's about 10% of the market cap. Not exactly, because the market cap's $2.3 billion, and they're doing just about $200 million in free cash flow. But it's pretty close. So I want you to ask yourself, if Fluor were to turn positive, if they were on an earnings basis to at least start breaking even, but actually making a little bit of money, a couple $100 million, does this, will their cash flow and operating cash flow justify a higher stock price, right? As I mentioned, operating cash flow is 10%, even with the business in the chaotic state that it's in. If they start growing revenue, if they stopped having these cost overruns, if they started expanding in new business segments, I think that this is a very, very attractive business. And one thing that's also worth mentioning is their losses are beginning to narrow. 2019, $1.5 billion loss. 2020, $300 million loss. 2021, Fluor's management is now claiming that they will be making money. I'm kind of skeptical. I don't know. They say it's on a non-GAAP basis, so I want to see what is actually going to be excluded in that. But I do think that there is a path to profitability here. As you can see here, this is just to show you that Fluor's cash balance has been increasing. That's the operating cash flow that I had mentioned previously. But what is concerning at the moment is the value of their backlog is declining from 35 billion to 31 billion to now just 25 billion. So this doesn't paint the best picture, but the good news is Fluor about 2 years ago fired the whole management team, cleaned house, brought in new management, and they do have a history as being a profitable Fortune 500 company, as I mentioned, founded in 1912. And I think that the new management has some really promising segments that I will now outline. If done correctly, Fluor definitely has a path back to where they should be. So first, starting with their mining segment. I regard this as the cornerstone of what will be the turnaround at Fluor, what will lead to growth in their contract backlogs. Fluor is a leader in this segment. If you think that their oil business will continue to decline and they will continue having problems in that business, you have to then think, where is that demand going to go? If we're no longer going to be burning natural gas or burning oil in our cars, we're going to have electric vehicles, what are we going to use to store the electricity and generate the electricity that we need? Obviously, from this slide, you see that Fluor has identified some key metals that will be really important for the energy transition. Nickel, copper, iron, aluminum, lithium. These are all really, really important rare earth materials that Fluor's mining segment actually can take an active role in mining. Well, what do I mean by mining, actually? I should probably outline that first. When I say mining, Fluor's mining segment actually constructs mines. That's what they do. So if mining of these rare earth materials is going to become more common. You see on YouTube all these small startup companies that want to go and build a lithium mine, or they want to go mine other rare earth materials. Somebody has to construct those mines. And what's even more important is these mines themselves, doesn't make much sense to use carbon burning sources to mine these rare earth materials. So a lot of these mines are going to end up being electrified. Not to mention they're in very, very remote locations. I've even heard that a lot of these mines want to have renewables on site where they could generate their own electricity production. You, of course, need rail that lead to these mines in order to export the ore. This, I think, is all necessary for the energy transition that we're currently looking at to be successful. And Fluor has a major presence here. They touch every component of this. They could build the rail, they could electrify the mine, they could build the conveyor belts, anything in between. That's a really, really big focus of Fluor. And you see a lot of Fluor's mining customers pivoting towards this. On top of that, Fluor is a market leader in this segment. They have the most market share and are very, very strong in mine construction. Some evidence of this would be the BHP South Flank iron mine that was built in Australia. This mine actually cost about $3 billion, and that is more than the entire market cap of Fluor. Fluor's market cap being, as I've mentioned, only $2 billion. So these are the size of projects that are being built here. They're not very high margin. None of this EPC work is high margin, but this is one area where a lot of Fluor's oil assets are going to be able to pivot away from. And now, to answer that question that I posed earlier, will Fluor be able to stop doing fixed price contracts, which has been a source of a lot of their troubles? The best part about this mining work that they're going to pivot towards is that none of it is fixed price. It's all done on a reimbursable basis. As work is finished, they get reimbursed. If there are cost overruns, that is shared between the client and Fluor, rather than the onus solely lying on Fluor. This, of course, makes the business much less risky. And even as we have been seeing across much of Fluor's business, particularly their oil and infrastructure businesses, even as we've been seeing these cost overruns, mining has been completely unaffected and has been executing just fine. So the key here will be to expand their mining segment. That will really help the company. So the next thing I want to talk about is a potential infrastructure deal. A lot of investors are really excited about this, and it definitely will benefit Fluor. I'm a little bit skeptical just because of the fixed price problems that Fluor has been having in infrastructure. That being said, Fluor has done a good job on a number of projects in Texas, where the contracts have been finished on time and on price. So there are a lot of infrastructure projects in select regions that Fluor will be able to compete with and win work in those segments, and continue to increase revenue in their infrastructure business, and it will be profitable revenue. The infrastructure bill basically covers every single infrastructure segment that Fluor has, the notable ones being bridges, highways, aviation, that's basically airports, light rail, heavy rail. Fluor builds people movers, which essentially, like when you go to the airport and you get on light rail to move around the airport, that's something that Fluor builds. They build subways. It's just a very diverse set of infrastructure that they engage in. So an infrastructure bill would probably be really good for this segment. Fluor also designs and builds advanced manufacturing, technology, and life sciences facilities. Data centers, of course, really high growth segment. Data centers are going to see vast growth just because of all the information that humans put out there and that these companies want to collect. Advanced manufacturing. This is bullish in the scenario that there's more domestic manufacturing moving back to the United States, especially if there's any sort of automation. A lot of these electric car factories, automobile factories, that could be very bullish for Fluor. If those customers want to work with Fluor and build these factories, Fluor certainly has the capability to do that. But the primary one that they've been strongest in is biopharmaceutical factories. So notably, the most recent project was for Novo Nordisk, and it was a $2 billion active ingredient project based out of Clayton, North Carolina. Again, Fluor market cap, $2 billion. This whole factory that you're looking at is equivalent to the same price. Novo Nordisk was very happy with the project. They did a great YouTube video. I encourage you all to look it up, with Fluor, and they built this contract on time and on budget, and it was a very complicated project, but they did it, and this is really Fluor at their best when they're building these facilities. There's also Fluor's government business. While this business is going to get hurt a little bit with the Afghanistan withdrawal, Fluor was a major contractor focused on supplying the U.S. Army bases in Afghanistan. There's still a lot of potential in this business. They work very closely with the Department of Defense, working on everything from nuclear submarine propulsion to intelligence and a wide variety of solutions. There's also site remediation for old nuclear facilities that Fluor works on. And an interesting note from Fluor's new management is they said that they are going to be focusing on moving up the value chain in this business. And part of the reason why that's so interesting is because Fluor's rival, Jacobs Engineering, which I think just recently eclipsed Fluor in revenue, becoming the largest engineering procurement and construction company by revenue, publicly traded engineering procurement and construction company by revenue. Jacobs Engineering actually sold their oil business and bought a business that Fluor's government business focuses on, and they went heavy into this type of business. And so Jacobs Engineering works very closely with NASA. Fluor has a similar sort of relationship with the Department of Energy. So if Jacobs Engineering used this type of business as the foundation of their turnaround, I certainly think that Fluor will be able to do something similar and really be able to grow this business to possibly take on Jacobs, maybe not to the same extent because they have a lot of other businesses they're focusing on, but certainly they should be able to have some success here too, just like Jacobs has had. Oh, also I want to mention that these two businesses, the government business and the advanced technologies and life science businesses, neither of those are fixed price businesses. Those are all, again, cost reimbursable. So just to really, drive home that point, I think there is non-fixed price business for Fluor to pick up and work on. And not only that, but it is outside of the oil sector, and it will be perfect for them to pivot towards this. They're very lucky because they don't have too many specialized assets for these segments. They're very asset light, as their investor relations people have written to me. They're very asset light, and they're able to make this pivot easier than a company that had a lot of specialized materials and was really, really entrenched in just oil and gas. So with that being said, let me now talk about their oil and gas business. So I already mentioned, I think chemicals, that is probably a really promising business going forward. Chemicals, there aren't a lot of alternatives to petroleum-based chemicals. Even then, there's ammonia. One of the interesting topics Fluor has talked about was having carbon-free ammonia. I think they called it green ammonia. That will be really interesting to see if they could pull it out. And Fluor's CEO actually highlighted chemicals itself as a big growth segment, just like mining. So that's going to be very interesting going forward. And just a reminder that 45% revenue figure that I said at the beginning of this video, that includes chemicals. Now we talk about LNG. LNG may have some sort of strong or at least not a weak future, just because of the sheer amount of natural gas that we consume in the world. Things such as cooking or heating, power production. There's a lot of natural gas-based power production. So LNG probably for the foreseeable future will be a okay business. There should be some CapEx spending there. As I've mentioned, I don't feel very strongly about oil and gas. I don't think that will be strong. But it's possible that it doesn't decline anywhere near as fast as I'm expecting. And if oil prices keep rising like they do, there could actually be some decent spending here, and that could be a positive surprise in my analysis. There's also carbon capture, which Fluor has the ability to do. I have heard from industry sources that they're not as competitive in carbon capture, but it's certainly an area that management is very focused on. And if they could get competitive in carbon capture, this could be a good part of their business. They've done this work before, and carbon capture, I think, is probably going to be a decent business, especially for things that we can't decarbonize, like petrochemicals. Batteries, I think it's actually Tesla's batteries use some sort of petrochemicals in their cars themselves. So that would be really interesting if instead of using oil that you drill, you could actually sequester carbon and use that as an alternative, and still be net negative on carbon emissions. There's also hydrogen, which I think is very promising for Fluor. They've mentioned that that's something that they're really looking forward to working on, and they're going to heavily lean into. And of course, there's nuclear-related projects that they want to work on and have worked on in the past. Of course, a subtext of that would be NuScale, but that is for another video. So, just to summarize, Fluor's business can, in my opinion, pivot away from oil and gas. They have other work that they could work on. They're going to finish these lost contracts, and I am of the opinion that there will be no new cost overruns on contracts that they bid going forward. That's really the key. You may still see some existing projects in their backlog that were done under the old management when they were pursuing the fixed price strategy. Those may still have cost overruns, but a key metric here is going to be new contracts that enter the backlog. Will they or will they not have cost overruns? And I think, personally, I think the answer is no. So, if you enjoyed this video, please give me a like, consider subscribing. I put a lot of work into this, and hopefully I'm not crazy. Maybe I am crazy. If I'm totally off base and out of touch here, please let me know. But without further ado, I think I'm going to end it here. Thanks, guys.